Hey everybody, it's Chris Kirkpatrick with Life 180, and this is my buddy and business partner, Caleb Guilliams with Better Wealth Solutions. And if you haven't watched already, we have a video on how to properly structure your life insurance policy, a whole life insurance policy more specifically. And we've had a ton of rave reviews and I just a bunch of positive feedback. And then we've also had some people who are asking questions about how can we make an illustration, or could we make an illustration that and kind of give an example and talk through for people who couldn't afford the huge premium that was used in that video. So what we've done here is we've taken it and we've scaled it down a little bit, and we're going to walk through a couple examples as quickly as possible on all the different ways that you can structure a life insurance policy, a whole life insurance policy for you. And we're utilizing a $10,000 annual premium, so that's under $1,000 a month. From a savings perspective, if you're an entrepreneur, specifically if you're a business owner, if you're just looking to save and build a rainy day account, I mean, for all things considered, you're not going to find anything that can beat what we're about to show you. So without further ado, I'm just going to kind of sit here with Caleb.
Be the color commentator.
Yeah, exactly. And you'll get to see my face and me laugh while he goes through this, because it's amazing. So
I get really excited about this. I'm a nerd, but I believe, and my goal for this video is to help you understand how to read an illustration and what to look for. And we're going to look at 4 examples. Number 1, we're going to look at a typical traditional whole life. And this is where I'll say I agree with Dave Ramsey to the point that I would not recommend anyone put their money in a design like this.
Totally.
Then we're going to look at a overfunded policy, but not a max efficient overfunded policy, but I want you to see the difference. Then we're going to look at a even more overfunded policy, and then we're going to show you what we do with almost all of our clients that have extra money going in, a lump sum.
I love it.
It's going to be great.
This is going to be amazing.
Okay, so when you're reading an illustration, every company is a little different. What we did is, this is one of the companies that we work with. We took out all the logos so that this is not an endorsement for any one company, but there's a difference between base, PUA, and a term rider.
PUA is paid up additions.
Paid up additions, and that's what's the cash that gives you the money. So there's base, paid up additions, which give you the cash value, and then the term rider is what we add to help get more money in if we need. In this contract, the base is the only thing that we're showing. We're not nothing's added as it relates to paid up additions, and so the $10,000, you need to pay that money. That is the annual premium, and you either need to pay that or you need to take from the cash value, which you'll see is very small.
Right.
And so one of the first negative things about a base contract is there's no flexibility when it comes to the premium. The other thing that you'll notice is year 1, you put $10,000 in. Year 1, the cash value is 0. Now let's also look at the difference between guaranteed and non-guaranteed. Guaranteed column assumes that dividends never get paid ever. Never get paid in the history of the
Or you're just meeting the minimum dividend, right? Or
we're just looking at the guaranteed no dividend. This is the guaranteed 4%. Right. And so this is this column. The non-guaranteed is assuming that dividends don't go up or down, they just stay the same. So here's where I think we're at with where we are with our country is I see dividends going down a little bit in the short term, and I see long term them being pretty consistently low or maybe going up.
Mm-hmm.
I don't see them continuing to drop negative.
Can't go down much more than we are right now.
Right.
But so when you sell this to no matter what, or you're trying to get people to understand this, you sell in the guaranteed column or do you sell in the non-guaranteed or somewhere in the middle?
I want people to understand the guaranteed column because remember, life insurance has nothing to do with rate of return.
Right.
But I also think the non-guaranteed column is pretty conservative.
Yeah. Okay. I'm with you on that. So just to I want to say this because if you look at this, I just want to reiterate, because I have a lot of views of my Dave Ramsey video and it's titled Why Dave Ramsey is Right, Life Insurance is Not a Good Investment. This is exactly what he's talking about, and this is why the pundits out there that are against life insurance is because they look at it as this is the only option. And he's about to show you that nothing could be further from the truth.
And I also want to show you this. This $10,000 is almost getting you $1 million worth of death benefit. Okay, it's $956,000, and you can see that the death benefit slightly goes up, but barely.
Yeah.
Okay. And I also want you to know this, that in year 4, you're paying $10,000 and your cash value is actually now increasing by more than 10,000. And every year after that, your contract is getting efficient. And where is this break even? This break even is in year 14.
Yep.
Pretty much in year 13.
Yep.
So even with a total base contract, if you're playing the long-term game, you could justify that long-term. This could be a good thing. But again, Chris and I doesn't
account for inflation. There's some negatives there, like whatever. So, but the reality is this is not anything we would ever recommend to anybody.
Right. All right. Now moving on to a typical design that many people that teach the velocity banking, cash flow banking, infinite banking, whatever you want to call it, do a 60-40 split. And again, there's nothing wrong with the 60-40 split, and you'll see a big difference. And I want to break this down. And so 60-40 meaning 40% is going to base, meaning instead of having a base of $10,000, now your required payment is $4,000. Which, Chris, why is it important to have flexibility as an entrepreneur?
Well, it's just cash flow and just access to capital. It's you don't want to be tied in. Like if you have a $10,000 premium, I don't know about you, but I've had years and months and whatever. If you're paying monthly or annually for your premium, you don't want to be stuck. Having to make a premium with a negative cash flow month and just compound your negative cash flow issues, right? It's horrible. And
one of the big things is not only are we lowering the base premium, but we're also giving you a lot more cash value.
Well, look at the death benefit too. The death benefit is 40%. Or was it
$500,000 difference? If you look at the base, it's you're paying really for that permanent death benefit. And what we're doing here by putting 60% into paid up additions, which paid up additions stand up, they're really, think of it like Lego blocks, one-time insurance deals that you put on. So it's a very efficient way to put cash in. And you can see, instead of having zero cash value in year one, you have $5,811. Now, just to let you know, this is money that you have access to borrow against, and your policy is still going to grow the rest of your life. We can talk a little bit more about that in a different video about non-direct recognition and how these work. But you could just see a huge difference. In year 5, you put in $50,000, you have $43,000 accessible, and in year 9, and really in year 8, and this is what I would say is the whole break-even idea. If you understand what's going on, you're working with a great company, it doesn't necessarily matter because you're playing the long game, but you also want the ability to access capital. But you can see a huge difference. We're putting in the same amount of money. The difference is the death benefit is a lot smaller. It's growing more rapidly. And there's a lot more cash value.
But the fact that the death benefit is smaller, you have more paid up additions, the 40% base, you're looking, this policy compared to the first one that we would never recommend is the internal costs are much lower. So it's going to operate much more efficiently.
100%. All right. So the third illustration, we're going to look at actually a $2,500 base, meaning we're showing $10,000 going in for the next 20 years. But at any time, the actual required minimum premium is $2,500. You want to talk about flexibility? That's extremely flexible.
Totally.
And you're actually seeing more cash value go into the ability to borrow against.
You have access to it.
Right.
Yeah.
But here's the big difference is for us to get this base and PUA combination, we need to add a term rider. Now, this term rider, think of the term rider as an expense that we add on, but it's a cheaper expense. And as a result, we're able to put more cash in. So it's all about maneuvering and designing a plan and reverse engineering it for the cash. And you can see that this term we're just doing this so that it doesn't become a taxable event, but we're bringing this term all the way down because at the end of the day, if you're 80 years old and still paying term insurance,
it's going to get costly.
And that's one of the reasons why index universal life or universal life can be so damaging we're bringing this down. Most of life insurance is on a whole life chassis, whereas other products out there are the exact opposite. And this is what I would say is this is more flexible, it's cash rich, way less commission, and the death benefit is comparable, but it's really because we're getting term insurance.
The actual whole life death benefit
is smaller.
Is much smaller.
And again, you can see this thing continue to grow, even though the term is going down, the paid up additions is making this net death benefit higher. And let's look at the break even here. it's year 7. Yeah. And again, if you're someone, when I first started, I was like religious on the whole break even. It does not matter.
It doesn't.
And we'll do
more videos.
We'll do a video on that, because I get so it's so discouraging when people are looking just at the break even. But it is important. It's like, okay, the reason the break even is important is if you're like, I want to cash out, you can technically say after year 7 you're not losing money, but you could say that loss. You could totally argue that point.
Inflation, you could say, but I would say this is once again, this is not an investment. This is a storage vehicle to help you operate your life more efficiently and look for better investment opportunities, right? So like, I just want to use this one example. Like year 3 in this contract, you have 24,000. If in year 3, let's say 3 years from now, and this isn't beyond the scope of or realm of possibility, the economy goes down, right? And we have an economic correction. If there are real estate opportunities, your ability to have access to capital to capitalize on those real estate opportunities are huge, right? So
100%.
Now you have access to cash, which if this were tied up in a 401k or any kind of qualified plan, you're not going to be able to touch it. And so having access to that 24, even though you may take a loan against it and then put it back in based on how you work with that asset, you could literally, it won't reflect inside of the policy, but you're going to have outside transactions outside of this policy that will create revenue for you, create investment opportunity, create money and a better quality of life for you that are not going to be ever reflected in this. And that's the part I think that most people miss.
Well, and here's another thing is this cash value you have access to use to borrow against, but your money's continuing to grow. So let's take a step back. Over 20 years, you put $200,000 in. In this example, you have an additional $91,000 of money that's growing without you having to put in extra work. And what did you do the last 20 years to take that capital and 10x it?
That's why I always say, if you're comparing this to an investment, you're thinking about it backwards. You need to compare this to a bank account. And when you look at the benefits that this has compared to a bank account, with all the living benefits, with the growth, with the guarantees, with the death benefit, with the tax advantages of this, especially the tax advantages from a legacy perspective upon death, like, it's the biggest no-brainer I've ever seen in my life. But
all right, now we're gonna get on to the last piece, and this one is my favorite design.
This is
my favorite design, because so many people come to us and they're like, okay, they're entrepreneurs, they don't necessarily want to have an annual premium of like something crazy, but they have additional money that they're sitting on, whether it's a savings account, whether they sold a real estate property, whether they sold. And so what we do, and we're using a $10,000 example, this could be $300,000 dump in, this could be, it does not matter what the number, we just wanted something super relatable. And this person right now is putting in $30,000 year 1. They have over $26,000 of cash value immediately.
So that's like 90% liquidity.
Yeah, it's insane. And then every year after that, they can put up to 10,000, but they can go all the way as low as 2,500 because
it's a flexible premium in the sense that they can pay anywhere between 2,500 and 10,000.
Right.
And that 10,000. So this example with the guarantees is showing based on 10,000, but if you wanted to put in 2,500 because your business had a bad year, or because for whatever reason you were cash strapped, you have that flexibility.
And just so you know how this works, the way that we fit in extra money is the term rider is higher. And if you look at the difference, it's 135,000 versus 500. Now, by the way, it's still the most efficient because look at this death benefit. This death benefit is smaller than the base contract with no lump sum. And so what I would say is, this may be like, you might look at this and be like, okay, there's a lot going on. But I want you to know that when we reverse engineer, we take your assets that you have, we take your cash flow that you want, and we really make sure that we don't we look at the minimums, and we want to make sure that worst case scenario, we can cover the minimum. And the worst case scenario is you can't fund anything year 2.
Right.
And so what we would have, and this is, again, I want you to go inside my brain. If this person right here put $30,000 in first year, and then year 2, everything hit the fan and nothing's working for them, we could pay the base premium easily out of their cash value. That's the way that you need to be thinking. As entrepreneurs, we want to create capacity to save as much money as possible. We also want to make sure that we are making this extremely flexible, because we don't know what life is going to throw at us. And so just in summary, a base contract, no PUA, no term, 0 cash value, not very good. Then we design this 60-40, meaning 40% base, 60% PUA. This is decent.
Which from a long-term perspective, by the way, probably has a bit of maybe some of the best cash accumulation.
Long term, this could be stronger, mainly because when you hit year 21 and you're putting $4,000 in, and your cash value is growing by, over 25,000.
Sure.
You want to put as much money in as possible
at that point in time.
So the reason why the base and PUA, like we don't get too, like we really figure out your situation, is maybe early on you're ahead, but long term, when you're putting $1 in, you want $5 back. You want to put as much money in. And in this example, it's better early on, but you wish you could put more money in when the contract is giving you $5 for every $1 you put in. Yes. And then this one, obviously the lump sum is like the best kept secret in this business. If you have money that you can put in year one, this thing will change your life.
And so I want to just say, you mentioned we do this, we do the 1-year term because of you want to avoid MEC, right? The modified endowment contract. So my mindset with that is anytime, just so you know what a MEC, what a modified endowment contract is, it's basically a line that government, it's kind of this moving target line based on all the variables that go into building a contract. And if you cross that MEC line, you lose all the tax advantages. The government knows how powerful this is from a tax advantage perspective, right? It understands that. And so it limits how much you're able to do. And so I don't know about you, but for me, anytime the government's saying this is so good that we're going to limit your capacity to do it, I'm going to push that envelope. Like,
Same.
That's just me. So that's the way I look at it. So to me, that's just common sense. Like if you're a business owner and you're trying to create more capacity to grow your business and create more wealth, and there's no other investment. We say it all the time. You're probably sick of hearing is that you are your best investment and you're your own best asset. Like this, you can see it speaks right to it. So
100%. And that's it.
Cool. All right, brother. Well, thanks guys. I hope this helped. If this makes sense, if it's, drawn up curiosity for you, if you're curious about what this may look like in your life, I want two things. If that's you, then there's a link below. Go ahead and click on that link. It'll bring you to a page. You can check a bunch of information out where you can dive deeper, learn a little bit more about you, and kind of go from there. I also know that I have a lot of agents, life insurance agents, that are looking to learn, honestly, because most companies' training is, quite frankly, garbage. And that's one of the reasons the insurance industry has got such a bad rap, is because most people out there are doing the first example that Dave Ramsey hates, right? And so, and I get it. That's 95 to 98% of the agents out there. And so if you're watching this, I commend you for your commitment to your practice to learn. Caleb wrote a book called The And Asset. I actually got it right here.
Shameless plug.
Shameless plug. This is an amazing book, and he wants to give it to you, whether you want to read it for your own personal finances or whether you're an agent. You read this book, it'll help you communicate with your clients better, and you can actually get a bunch of them if you want to share with the clients. And Caleb, if you don't know it, he's on a mission to help 1 million people in the next 5 years, and I'm telling you, this book is going to change the world. I believe it. Like, I've been around, I've seen a lot. There's a reason I'm working with this guy. He's amazing. And go ahead and click on the link below for that. There's going to be 2 separate links. Check it out. And we just look forward to serving you guys. If you have any questions at all, go ahead and write them in the comments below. I try to be as amazing as possible about responding to them. Sometimes there's a ton of them and it gets hard, but I'll definitely do that. And until next video, go out and crush it, live abundantly, live efficiently, live life 180. We'll talk to you.